War has been declared between Iran and Israel, and the shockwave is already ripping through precious metals. Silver is pressing into the mid-90s, tokenized gold is flirting with its record, and in China, people are paying a massive premium just to touch real metal. This is not a markets are nervous story. This is a the plumbing is bending story. If you blink, you miss where the smart money is running. Here's what happened, in plain English. Military escalation hit the tape. The world repriced risk in real time, and the bid for hard assets got louder. Silver snapped higher toward $95. PAXG surged near its all-time highs around the mid-$5,600, and Shanghai physical gold started trading far above Western spot, with buyers reportedly paying roughly a $282 premium per ounce. That spread is not a rounding error. That spread is a warning. Now, before we go any further, forget the noise. Forget the clickbait targets. Forget the silver to the moon tomorrow fantasies and the this is over, go home, doom. This market does not care about your feelings. It cares about supply, demand, trust, and fear. And right now, all four are moving at the same time. Let's lock down the scoreboard. Silver is hovering around $94 to $95 this week, with traders eyeing the psychological $100 level like a tripwire. Gold in the global spot market is around the low 5,200s. PAXG is trading around the mid-5,400s, within striking distance of its prior peak near $5,629. In Shanghai, physical gold is around $5,560, implying that fat premium over Western pricing. And yes, silver recently printed a wild high near $121.67 on January 29, 2026. If you missed that day, you missed the part where the market screamed, "We can move." Then came the other part of the movie, liquidation. A fast, ugly drop that erased roughly a third in days. That kind of volatility is not a sign the market is dead. It's a sign the market is contested. Here's the question you should be asking. Was that spike just leveraged madness? Or was it a preview of what happens when physical reality collides with paper promises? Because your entire strategy changes depending on the answer. Let's talk about the China premium first, because it's the clearest signal on the board. When a region consistently pays hundreds of dollars above global spot to secure physical gold, that means one thing. They don't trust the price unless it comes with delivery. In other words, they're not buying a chart. They're buying a bar. And when physical pulls away from paper, two things happen. 1. The West loses metal. 2. The paper market gets more fragile because it's built on confidence and rollover. You can smash a price on paper. You cannot smash a line of buyers demanding delivery. Now layer in PAXG. Tokenized gold isn't the same thing as a meme coin. It's a bridge for people who want gold exposure with crypto-style transfer speed. When PAXG pushes toward its highs while physical premiums rise in Asia, that's the market whispering that digital convenience and physical scarcity are both rising together. That combination is rare, and it usually shows up when trust in cash is falling. Okay, so why is silver moving like a wild animal while gold moves like a glacier? Because silver is not just a monetary metal, it's a critical industrial input that the modern world refuses to stop consuming. This is the part most people miss. Silver's demand is not one story, it's three stories stacked on top of each other. Story 1, investment. In fear cycles, people reach for metal that feels like money. Story 2, industry. Solar, electronics, power infrastructure, and high-efficiency components keep pulling ounces out of circulation. Story 3, supply constraints. Mine output is not a faucet you can turn on next week, and recycling is not a magic wand. When those three stack, silver stops behaving like a normal commodity. It starts behaving like a bottleneck. The industry angle isn't optional. Solar installations have been accelerating globally, and silver is embedded in the photovoltaic supply chain. EV and grid upgrades add another layer of demand, and the next wave of electronics and high-frequency infrastructure keeps chewing through conductive materials. Here's why that matters for you. Industrial buyers don't time the market the way speculators do. They secure supply. They sign contracts. They pay up. They treat metal like oxygen. You don't negotiate with oxygen. So if you've been watching silver and thinking, it's just a trading vehicle, you're playing checkers while the supply chain plays chess. Now add the deficit narrative. We keep hearing that the silver market has been running structural shortfalls for multiple years, with cumulative deficits stacking into the hundreds of millions of ounces. If that's even close to true, it means inventories have been acting as the shock absorber. And shock absorbers fail when you hit potholes at highway speed. War headlines are potholes at highway speed. So when you see silver at $95, don't just see a number. See pressure. See a spring being compressed. Here's the next layer nobody wants to say out loud. The paper market can only dominate until it doesn't. It works as long as people accept settlement, roll contracts, and treat exposure as equivalent to metal. The moment a meaningful chunk of players demand delivery at the same time, the system has to choose. Cash out, ration, or reprice. That's when you get the violent moves people talk about for years afterward. Now I want to be careful. That scenario is possible, not scheduled. The timing is the trap. People go broke being early, not being wrong. But ingredients matter. And right now the ingredient list is ugly for anyone leaning on silver can't stay high. Let's run the macro overlay. A slowing growth backdrop plus sticky inflation is the exact environment where hard assets tend to gain oxygen. If markets expect rate cuts later in 2026, that expectation alone can support metals. Why? Because cuts don't just change yields, they change confidence. They tell you the system is shifting into support mode. And when the system shifts into support mode while war risk rises, the question becomes simple. What is the safe asset? For some it's treasuries, for others it's gold, for others it's a mix. The point is the same. Capital moves toward perceived safety, and metals are a traditional recipient. Now let's address the elephant in the room, the January blow-off and the crash. Critics will tell you it proves silver is a casino. Supporters will tell you it proves silver is the future. Both miss the real lesson. The real lesson is leverage. When a market gets crowded and leveraged, it can spike and it can puke. That doesn't invalidate the underlying trend. It tells you the ride is not smooth. So if you're positioning around this, your edge is not predicting tomorrow. Your edge is building a plan that survives volatility. Because the next move could be a clean breakout over $100. Or it could be a gut punch back into the 80s to flush late buyers. And if you have no plan, you'll be emotional at exactly the wrong moment. So what do you watch right now in the real world? First, that China physical premium. If it expands beyond roughly $300 and stays there, that's not hype. That's sustained stress. It suggests physical demand is outrunning available supply, and it tends to pull metal east through arbitrage and inventory drawdowns. Second, the gold to silver ratio. If gold keeps outrunning silver and the ratio stretches, it can set up a silver catch-up phase. If silver starts outperforming and the ratio compresses, that's when silver can go vertical. Ratio compression is the kind of move that turns interesting into historic. Third, PAXG versus its prior high around $5,629. A clean push through that zone would be a psychological and technical green light for gold-linked flows. It's not magic, it's behavior. People chase breakouts. Fourth, supply headlines. Watch for mine guidance cuts, disruptions, strikes, permitting problems, or anything that hits output expectations. Supply shocks in a deficit-prone market are gasoline. Fifth, geopolitics. Not the drama, the escalation ladder. Watch what expands the conflict, what pulls new actors in, and what threatens energy routes. Markets don't price morality. Markets price disruption. Now let's talk about the targets everyone loves, because I'm going to say something that will annoy both camps. A price target is useless without a trigger. If someone says silver to $135, your next question should be, what forces it there? If someone says silver to $39, your next question should be, what breaks for that to happen? Both can be said with confidence, so here's a more useful framework. Scenario A. War risk cools, the dollar strengthens, growth slows hard, industrial demand softens, speculators unwind. Silver can retrace. In that scenario, a pullback does not mean the story is over. It means the market is clearing froth. Scenario B. War risk persists. Rate cuts come into view. Physical premiums stay elevated. Supply issues continue. Investors rotate into hard assets. Silver holds the 90s, presses $100, and the market starts treating triple digits like a base, not a ceiling. Scenario C. The nightmare for paper shorts. Physical tightness becomes undeniable. Delivery demand rises. Premiums don't collapse, they grow. Then price doesn't drift higher. It jumps to a level that rations demand. In that world, you don't get a polite bull market. You get a repricing event. Now, I'm not here to sell you a fantasy. I'm here to tell you what the market is whispering. And right now, the whisper is that trust is moving from paper to physical. That's why PAXG matters. That's why silver's volatility matters. It's not random. It's a fight between two worlds. The world of contracts and the world of atoms. Here's the part that really separates amateurs from pros. Risk management is not optional in a market like this. If you go all in because you're excited, a 10% drop will feel like betrayal. If you size appropriately, a 10% drop is just a Tuesday. The market punishes desperation. It rewards patience. So if you're bullish, you don't need to be reckless. You need to be prepared. Prepare for spikes. Prepare for smashes. Prepare for headlines designed to scare you at the exact top and soothe you at the exact bottom. Because when a market becomes a geopolitical scoreboard, the narrative becomes a weapon. Now let's bring this back to what happened today, because this is where your edge gets real. War declared. Silver near $95. Gold near the mid-5,000s. PAXG close to its highs. China paying hundreds over spot for physical. That cluster of signals points in one direction. The world is paying up for certainty, and certainty in markets is expensive. So here's what you do with that. You stop treating metals like a meme. You treat them like a system indicator. When the spread between physical and paper widens, it's not just about profit, it's about confidence. When confidence in paper thins, assets that can't be printed become more than investments. They become exits. Now let's go one level deeper on the mechanics, because this is where most coverage gets lazy. When people say silver is manipulated, they usually mean one of two things, and they mix them up. 1. Heavy paper selling can push the quoted spot price around, especially in thin hours. 2. Physical tightness can exist at the same time as a soft paper price, because the paper market is trading exposure, not bars. Both can be true. And when both are true, you get the weirdest feature of this market. Spot falls while premiums rise. That's not conspiracy, that's structure. If a dealer is charging you a much higher price than the screen, it means the screen price is not clearing the physical market. The screen is clearing paper. Physical clears at the point where someone parts with metal. When fear shows up, fewer people part with metal. Premiums rise. The screen can lag. Then it snaps. That snap is the move people remember, and it creates a pressure loop. If the spread is wide enough, global traders try to arbitrage it. They buy cheaper metal where it's available and sell where it's expensive. But here's the catch. Arbitrage only works if you can actually source metal, transport it, clear it, and deliver it. In calm markets, that's easy. In stressed markets, it's not. Shipping, insurance, logistics, and regulation become friction. Friction means the spread can stay wider for longer. Wider for longer means more people notice. More people noticing means more demand. More demand means the spread can widen again. That is how you get a runaway premium. Now, silver has an extra twist. It's smaller than gold in value terms, so it can move faster. Gold is the aircraft carrier. Silver is the speedboat. The speedboat flips in storms, but it also outruns the carrier when the tide shifts. That's why the January move was so violent. It wasn't silver discovered gravity. It was a speedboat hitting a wave of leverage and fear at the same time. And then the liquidation hit. That liquidation is important because it tells you where the weak hands were. It flushes. It resets. It also teaches you a brutal truth. If you're using leverage, the market is not your enemy. Your margin is your enemy. Now about PAXG. People treat tokenized gold like it's either flawless or worthless. Both takes are lazy. It's useful because it's liquid, fast, and accessible. It can be moved and traded like a digital asset while referencing physical gold. But it carries ecosystem risk, platform risk, network congestion, market-wide deleveraging, and most importantly, the human risk. When markets panic, people sell what they can, not what they should. That can create temporary dislocations, even in assets that track something stable. So if you're watching PAXG near its highs, don't just stare at the price. Watch the behavior. Watch whether breakouts hold during risk-off days. If it holds, that's strength. If it breaks out and instantly fails, that's a tell. Now let's address the "what if I'm wrong" section, because this is where real investors live. What could cool this entire setup? A sudden de-escalation, a ceasefire that holds, a risk-on surge that strengthens the dollar, a sharp global slowdown that hits industrial demand, or a policy shock that pulls liquidity out of the system. In any of those cases, metals can retrace hard, even if the long-term thesis remains intact. And that's why you need levels, not vibes. Silver in the mid-90s is not just a number, it's a battlefield. If it holds and consolidates, it builds a launch pad for $100. If it loses traction, it can dip into the 80s to rebuild. Neither outcome is good or bad. The mistake is reacting emotionally instead of tactically. Here's the real cliffhanger. It's not where does silver go next. The cliffhanger is how much stress can the system absorb before it reprices the quote to match the physical. Because if the quote has to move to match the physical, it doesn't move by pennies. It moves by dollars. And if you're still treating this like a normal market, you'll get blindsided. So let me challenge you with one thought. If buyers are willing to pay a $282 premium for physical gold today, what do you think happens if the conflict expands and capital controls tighten? Do premiums shrink, or do they explode? Because if premiums explode, the global spot price becomes a suggestion, not a reality. And when that happens, the chart you've been staring at is no longer the truth. Delivery is the truth. And delivery is where the next wealth transfer happens. So here are the two questions I want you to answer in the comments. Real answers, not slogans. 1. Do you think silver breaks and holds above $100 this cycle, or does it fake out and retrace first? 2. If you could only pick one signal to watch for the next 30 days, China Premium, PAXG breakout, or the gold to silver ratio, what are you watching and why? Drop your answers below. Now, quick and simple. If you want updates like this without the fluff, subscribe, because the market doesn't send you a calendar invite before it reprices. And one last thing, don't confuse silence for safety. The biggest moves in metals often start when the headlines calm down, not when they scream. War declared is the spark. Premiums are the smoke. Price is the fire. The only question is how far the fire spreads. Stay sharp.